9:15, markets have opened the first rates any seconds now and they have started kicking in. It's a full house. When I say full house, it's a full house of green, Nifty, Sensex, small cap, mid cap, everything is powering ahead. The breadth, touch wood, again, phenomenal breadth in terms of where the current market positioning is. The breadth, I think, has been the talking point. The breadth really has been the high point, so to speak. Now let's look at banks and the bank Nifty especially, because for markets to move higher, it's the bank Nifty which will have to do magic. The bank Nifty is chugging along very, very smartly, and the bank Nifty in a sense is going to be the important one. Now let's look at newsmakers. Not too many newsmakers, but Astra DM, Zomato, RPG group companies, RPG Sanjeev Goenka group companies, let me put it this way. Aster DM $1 billion comes in, but I think markets knew this was coming. Zomato block deal, which means the ant overhang now seems to be reducing significantly, and that in a sense is a big hurrah. Now Adani group of stocks, can we forget them for long? No sir. Adani Enterprises, the holding company, Adani Ports, Adani Wilmar, Adani Power, Adani Green, Adani Total, all of them are just doing what they've done for entire 2021. Does not matter what's happening in the world, but Adani group of stocks are chugging along very, very, very smartly. So it's reminiscent of what we saw in 2022, Aisha. Every day Adani group of stocks went higher, and today I think that is at play.
Yeah, absolutely. Continues to chug along nicely. The Nifty well above that 19,900 mark. In fact, just 25 points and we should make it to 20K once again. And I think that's been a long way to actually clog back to those levels. Let's see what Siemens are up to. Their numbers were above estimates. Margin uptick of 100 basis points like we were earlier flagging off. There's Aster DM as well. We just spoke with the management. They're selling their Gulf business for a price consideration of about $1 billion, 3% higher for Aster DM Healthcare. Zomato we already marked. PCBL as well is the other one in focus. They've acquired Aquafarm Chemicals for 3,800 crore rupees. Tata Power, you just heard from the management too. They've got an LOA for development of a 200 megawatt firm and dispatchable renewable energy project. So look out for what that stock as well does. Manappuram, wherein they've reiterated the guidance in the analyst meet. There's Man Infra too. The board is meeting today to consider a fundraise too. So that's another stock which is in focus. So loads of these counters really. And let's revisit what Tata Motors is up to. It's already at that 700 mark. Where to next for Tata Motors? 699 is where that stock is. So still just struggling at that level or a little sub that level. Much unlike what the pre-open rates were indicating. What about the underperformers from yesterday? So I want to revisit what L&T, RTC, ICICI Bank, Kotak Bank, Reliance Industries are up to, considering they didn't participate at all in the market move yesterday. And today too, they're pretty much on the sidelines, just marginally higher, a little bit here or there, really, for some of these large cap winners. Kunal, any trend or trade that you're picking up?
So I think again a good start for the index, and Bank Nifty finally above the 44,000 mark. So that's a good sign. Hopefully more short covering across large cap names could take the banking stocks higher. Now the stock which I would look to trade in the open would be NMDC. The stock looks attractive. Yesterday it crossed back about the 175-77 hurdle. Today I think the stock is above 180 plus mark. So it looks attractive from current levels.
All right, Naresh, let's get in your first trade.
So that would be a buy on Container Corporation, Concor, which looks interesting. The breakout is done, expecting a move towards 800 in the short term and 850 also.
All right. Gautam Trivedi joins us. Let's connect with him. Let's understand his view of the market. Where is he finding value in this market? And well, Gautam, good morning. So nice to have you back. Well, you're always smiling, but today you're smiling with a big smile. So is there something which we need to know?
I don't own any of the Adani stocks, so that's a loaded question. Let me put that straight away. I'm smiling because it's just another good day.
Yep.
No low AQI and low pollution, so that's why I'm smiling.
Bombay is very clear actually. I mean, thank God it rained over the weekend, and the AQI levels actually last I checked were sub 100, and I don't remember last time when we had this kind of a number.
Exactly.
But it's not looking all that clear when it comes to markets, right? It's very foggy. Valuations are just not stretched. You really have to do a lot of hard work. It's like a Delhi fog right now. You really have to work hard to keep yourself safe, right?
That's right. I was in Delhi last week, right? It was, I think ranging from 350 to 450 on the AQI. And yeah, it was extremely foggy. But, here's the thing I want to share with you guys that I was in the US until a few weeks ago, and I met a whole bunch of institutional investors, discussed India at length and India versus China, which invariably came up. So I think the verdict was very clear that there's a lot of anger against China from an equity markets perspective. And a lot of people have obviously not really made any significant money in the Chinese markets for the last several years. And India, of course, has gone only one way. So as a result, I think the bias, the preference for India is undoubtedly very clear. Having said that, the single biggest hurdle that I saw was the valuation, in which at 20 times calendar next year, PE will still remain the most expensive large economy, large market in the world, which is not a surprise, but it seems to be a hindrance from especially US institutional investors to now incrementally put new money to work in the market. So even if you look at since the highs of September, we've seen almost $5 billion of selling. This month also, we've seen sub 100 million of net buying, which is really neither here nor there. So I think that these are things which I would be concerned about from a foreign perspective. But of course, on the domestic front, we've seen $20 billion of net money coming into the equity markets. And I think that almost 2 billion of net flows from retail investors into domestic mutual funds, I don't see that slowing down, frankly.
But, while I completely agree with you that the India appeal is so strong and money will come to India, but we've been talking about this theory for last 12, 18 months now. Where are the flows? Where are our friends? When will they come back?
I think we need to have a correction. Personally, I think a correction would be very, very welcome. There's a lot of froth in the market. A lot of stocks are extremely expensive. And, yes, we can stretch the timeline and say, oh, in that case, let's look at this stock now from a 3 to 4 year view. Let's not look at it from a 12-month view. So most sell-side research today is 12-month oriented from a target price perspective. They do have modeling for the next, FY26 up to FY26, but I don't see people being able to confidently say that now is a good time to buy the broader market because it is expensive. And I see a lot of research reports out there that maybe overweight India, but little confused on what stocks to actually put money into.
Okay. If one looks at your current ideas, top compounding themes, real estate, financials and EMS. I'm going to keep financials aside because that's something which you've discussed last time. But why real estate and why EMS? Because EMS is something some would say in terms of valuations has already run up. Most of the EMS stocks, and just few of them, 4, 5 of them, they're trading at P multiples of 40, 50 times already.
Yeah, so the EMS companies, I think, are where the Indian IT sector was 25 years ago. If you just look at even the absolute quarterly numbers which came out for the second quarter, the aggregate revenue was up 28% year on year. EBITDA was up 19%. PAT was up 24%. And these are not 4 to 5 companies. There are now 9 companies that are listed, which includes Amber and Dixon Technologies. I believe there are another 4 to 5 when I speak to investment bankers, another 4 to 5 that will IPO very shortly. So the universe is only expanding, as did the universe of the Indian IT space over the last 25 years. So I think this is a space where you will see incrementally more investments coming in. Literally, China plus one. If you were to pick one sector in India that will benefit from the China plus one, it's definitely this. So I think you are seeing increasingly MNC companies wanting to diversify. I mean, Apple being the poster child of what they're doing now in India, $4 billion worth of exports. Again, a small fraction of their 400 billion of top line. But the fact is, that's a great headline to have. And you'll see that number only incrementally going up. So hence, I'm very bullish on the EMS space.
Okay, fair enough. That's the rationale over there. Let's chat about another compounding theme, and that is auto. And at a time like this, a lot of these companies have been acknowledging that the festive sales haven't been all that great. A lot of companies resorting to price hikes, talking about inflationary concerns, raw material
Yeah.
prices going up. What's the outlook there?
I think the auto sector is another steady compounder, and I don't mean only just two-wheelers, even passenger cars. So I was reading the statistic literally this morning, which startled me, and it said that of millionaires in India, only 4% of them actually own luxury cars. So versus the West, which is where the figure is 60%. So I think the runway of people incrementally buying more luxury cars, whether it's BMW or Mercedes or what have you, will clearly be a huge positive for some of these companies. If you look at the numbers for Mercedes as an example, they've incrementally for the last several years only been going steadily up. So to the extent that the global CEO of Mercedes said India's for the next several years going to be their fastest growing market. I mean, fastest growing in terms of not volume necessarily, but percentage growth.
Gautam, I want to ask you whether there is any tactical positioning or you think that would be the case, be it for the state election results or in the run-up to the 2024 big one elections?
Well, I think, I don't like commenting on political outcomes and what may necessarily happen and how the market should react. But what I have said in the past is that if for whatever reason the BJP or the NDA do not come back to power in the 2024 elections, my view is it will be the two best days to buy India, because that's when the market will correct. And, people who have that foresight have a vision of where India is going to be 10 years from now, no matter which government really comes into power. I think those should be the two best days to buy the market.
If markets don't fall, then what should one do? I mean, what we're trying to perhaps understand from you is, okay, fair enough that if markets fall, you should buy them. But to buy, you need cash, which means you'll have to take a tactical call of raising 10-15% cash in your portfolio. Would you do that? Should one do that?
Ahead of the general elections, lightening up would be a good idea, because if for whatever reason the NDA doesn't come back to power, again, I'm not taking any sides here, but that's narrative that I hear from a whole bunch of market participants, including the ones offshore. And in fact, that was the one question that was asked repeatedly on this trip to the East Coast when I was there a few weeks ago, that will Prime Minister Modi get a third term? So that was clearly a concern besides the valuation, and concern in a good way, in the sense that if he were to come back into power, they would incrementally look at putting more money to work. So I think, yes, lightening up a bit prior to election results would be a good idea.
Let's look at something which is in the public domain, something which we've discussed in the past, your top holdings, Varun Beverages, Landmark, Inox Wind, Sampanda, Sampanda. Have your top 5 holdings changed, or are they still intact?
These are top 5 holdings on a mark-to-market basis. So these are actually companies that we, I guess that we are a bit more of a special sits fund. We do look for steady compounders as well. Varun Beverages, interestingly, was a special sits which became a steady compounder. Landmark Cars, as you mentioned, as I spoke about, the auto sector is the other story, which. So sorry. Hi, can you hear me?
Yeah, go ahead.
Yeah. So I guess Landmark Cars is the other sector where we just discussed about the auto space. Inox Wind, I think that's again a special sits sort of investment, because if you look at the government policy that's changed favorably towards wind, because focusing too much on solar of the grid, given the fact that solar energy is only available from 8 o'clock in the morning till about 4:30 or 5 p.m. in the afternoon. So you need to have a hybrid strategy of solar and wind, which is the reason I think now the government's going to be auctioning 10 gigawatts of wind projects every year for the next few years. So these are some of the triggers that we look for in companies, and I think these stocks will remain our core holding. The other one is Spandana Spurti, where the special sits or the incremental trigger was the fact that they got a brand new team led by Shalabh Saxena, who came in from Bharat Financial at Indusin. So that, and he's made significant changes, brought in, it's not just him and the CFO, it's a team of 10 to 12 people who've come on board to change the way Spandana has been doing their business.
Gautam, let's get in a quick take from you as well as to what the outlook is when it comes to new age tech companies.
I think that's a good question because I've been asked this before. And, what I guess the initial IPO reaction to a lot of these companies last year and early this year was pretty brutal. And I think that's also, the good news is it's also impacted the valuations in the private markets because at the end of the day, let's not forget the valuation of Indian tech companies, be it private or public, are influenced by the valuation metrics of similar companies in another country, i.e. the United States. So my view is that these companies or the market now seems to have, I guess, figured out a bottom for a Zomato or a Nykaa or a Policy Bazaar or a Paytm and said, okay, this is it. I don't think these stocks deserve to fall any further. And hence you've seen that rebound in Zomato. So I think the market's now starting to accept that there is a certain different valuation metric we should be applying to the new age tech companies. And I think, what I've said in the past on your channel is these companies are changing the way we live, whether it's a Zomato, whether it's, insurance online, or you're using your Paytm account to purchase goods. So I think these companies are changing the way we live, the way we behave. And going forward, I think these are companies you want to keep owning from a longer term perspective.
Really appreciate your time. Thank you so very much for joining us.
Thank you.
Markets, meanwhile, they are steady, they are looking good. And, one is actually surprised with the resilience some of the small and the mid-cap stocks, of late have exhibited. Well, there's one interaction I always look forward to, and that's Nikunj Mishra, Chief Economist with Axis Bank and Head of Global Research with Axis Capital. Nikunj, good morning. Thank you for joining us.
Good morning, Nikunj. Always a pleasure being with you.
क्या दुनिया लग रही है आपको? What's your view of the world?
You started with, you're forcing me to start with a negative comment. So, no, I'm very worried about the world. I think the financial markets are ignoring some very meaningful risks. I'm just hoping that we are able to navigate them and the regulators in the West are able to navigate them with some ease. So the biggest risk right now, I think, is the global cost of capital, the risk-free rate, the US Treasury yield, I think, is likely to spike up again when the world starts observing how bad the US fiscal condition is. And also the after effects of the crowding out that the US government is doing, which is driving significant dollar shortages in the rest of the world. So yeah, the global outlook still looks pretty bleak to me.
Why are markets ignoring this obvious risk? The fact that government balance sheets are getting bloated, they will find it difficult to sustain this kind of an debt servicing level. Interest rates are far higher than what they were 3 years ago. These are obvious concerns which perhaps are taught to you at a very elementary level when we read finance, but everybody is ignoring it.
So if you remember, this is in 2010-11 when the US Fed had given forward guidance that they would keep interest rates at zero for a sustained period. Even then, there was this disbelief that PE multiples on, say, some leading consumer names could be higher than 40-45 times. If you went and told some of the domestic portfolio managers that buy this consumer company at 45 times earnings or 40 times earnings, they would have thrown you out of the room. And over the decade, the market became used to higher and higher multiples. So 40-45 became 45-50, then 50-55, then 55-60. And these days I see people trading stocks because they used to be at 80 times earnings and they become 70 times earnings and suddenly they become cheap. So this is something that the markets adjust to over a period of time. And in the interim, in the near term, it's all muscle memory. And the muscle memory is that if the Fed has stopped hiking, then it must start easing. And if they start easing, then automatically the global cost of capital starts coming down, and let's start piling on to the emerging markets. And within emerging markets, let's start increasing the PE multiples that we should assume for most of the stocks. And so I think the changes will occur over a period of time. I've often said that equity risk premium, which is the excess return that markets demand for risky assets like equities, is a discovered metric. It is not a modeled metric. So you don't really assume a certain ERP and then you start buying or selling stocks. It is something that, like progressively over the, I was also like your previous speaker in the US. In fact, after that, I was in the UK, then in Singapore. So I've had 3 weeks of meeting global investors. And what you hear is that progressively, I think the economic indicators in the US and elsewhere are actually weakening. I'm surprised people are ignoring that despite all the supply cuts, oil is back at $80. These are very negative signs for global growth, and therefore, as the surprises and the shocks start coming through, I think we will see the markets correct.
So, Nikunj, what would it spell for markets like India? And I ask this because, in any case, the foreign investors have eluded us for a while.
So, see, I think the scenario for India continues to be time correction. There are 3 or 4 important variables to think about. The first is that the risk-free rate that we are used to is going to be significantly higher in the next 5 years than it was in the 5 years preceding the pandemic. So the US Treasury yield is not going to be 2.5%. It's most likely going to be 4.5%, if not higher. Which means that the PE multiples that we can justify 2 years out will be a lot lower than the PE multiples. It may not go back to the 13, 14 times that we saw in 2012, 13, but it could be maybe 16, 17 times and not really 18 to 20 times the range that for the Nifty that people have gotten used to. The second variable is that the $30 to $35 billion of annual unintended flow of savings into equities. For example, for most of us paid in the formal sector, 2% of our salaries go into the Nifty ETF, right? So 12.5% standard deduction, 15% of that goes into Nifty ETF. You add to that the SIPs, the insurance flows and all that. There is $35 billion of flows where people are not trying to time the market. It's just habitual, and those flows keep happening. So India's premium to the world will remain elevated. The third important variable is that the Indian economy is doing better than expected. In fact, earlier in January, there was almost a competition among forecasters that how low can you take India's GDP growth, right? So there were economists who were talking about 5% growth or 5.5% growth. Thankfully, the consensus is now closer to 6.5%, and I think the current run rate is well above 7%. So the economy is doing better than expected, and therefore earnings are actually behaving very well. And that's the last point. The muscle memory of the market is that earnings will keep getting cut. If you remember, in all of the previous decade, if the Nifty EPS started at 100 over the 2.5 years that a Nifty forecast lives for, right? So about a month back, we saw FY26 Nifty EPS come up. It'll last for about 30 odd months. Over these 30 odd months, there would be a 10 to 30% cut in the Nifty EPS. So every 3 months, you were losing 2-3% because of cuts, and you were gaining 3-4% because of the roll forward. What has happened post-pandemic in the last 2-3 years, particularly as the economy has done far better than feared, the earnings estimate cuts are not happening. So that was the most remarkable takeaway from this quarter's results as well, which means that the roll forward now is actually driving significant gains. For all of this year, Nifty's performance has been driven by EPS upgrades or EPS gains, and which is mostly because of roll forward issues. And the PE multiple has actually declined. So I think the market performance is increasingly being driven by roll forward gains on EPS. And so I think that the Indian market will time correct. But whenever the global accident, which is necessary for the Fed to find a valid reason to start buying government bonds again or start expanding its balance sheet, that reason will be a severe one. And I think that will drive perhaps a temporary blip down in the markets.
The outlook when it comes to the kind of liquidity situation that we've been seeing, at least over the past few days, the FIIs have been buyers. But what is the sense that you're getting over the next year with the overall election outcome, etc.? How are you looking at liquidity?
So as I said earlier, this is a blip. This is muscle memory that people think that U.S. Treasury yields fall off from 4.95% to 4.4%. And then emerging markets then become attractive, flows start happening. So if you assume, and if someone has an estimate that the US Treasury yield will keep falling, or will say 3.5%, then yes, I think the flows can sustain and will happen. But if you think about the $2 trillion of annualized deficit in the US, fiscal deficit, and you see that dollar availability outside the US. See, as Nikunj started off, we have all learned the theory that if the government's fiscal deficit is large, then the private sector gets crowded out. If the US government's fiscal deficit is large, the whole world gets crowded out. If you use a simple metric of broad money supply growth in the US, M2 growth, minus nominal GDP growth in the US, that is the most negative we have seen in the last 65 years. And which means that the dollars outside the US are getting sucked into the US to just finance and just to support its GDP growth. And which means that, say, take India. India, about 3-4 years back, even pre-pandemic, we could think of financing a $70 to $80 billion current account deficit because that was the nature of the capital flows. We are now, I think, going to struggle to finance a $30-40 billion current account deficit because net FDI, which used to be $45-50 billion, has shrunk by $20-25 billion. External commercial borrowings, which used to be a source of dollars, from a plus 15-20, likely become -5. And therefore, there is a substantial reduction. And India is not the only economy facing that. Indonesia is seeing that. Every other country is seeing that. And this is not going to end because the QT is still continuing, quantitative tightening. Credit growth in the US is still negative, which means that money creation by the banks in the US, the dollar creation is also slowing down. And therefore, this will create, this has to break at some point. So I think the liquidity, and whenever it breaks, there will be another stampede to into US dollar assets. And so I think liquidity will worsen. Once we have passed that speed bump, then I think, and so that's when the Fed will have to come out and start expanding its balance sheet. And once that does, then the liquidity conditions ease, and then we can feel a bit relaxed.
Nilkan, let's now address few things where everybody wants to seek your opinion. And these are some of the consensus views in the market. One consensus view in the market is, and since you flagged off this whole issue of, of current account deficit, is that post-elections, we could see a change in liquidity, but more importantly, because of the JP Morgan bond inclusion, it's going to be a free flow into the bond market. Is that good enough to take concerns, at least on the CAD front?
Okay. Let's first understand why is it that the bond market is not sort of front-loading before the index inclusion. In the equity markets, it is almost a business case now for predicting who will get included into the various benchmarks, and therefore the market buys those stocks, and then when the index inclusion actually happens, then they hand it over to the buyer side at a higher price. Why isn't it happening in the bond funds? And I think the reason is that people are quite wary of this whole issue I was alluding to earlier, that if US Treasury yields are going to be 4.5-5%, why do you really need to be in the emerging markets? And the quantity of dollars available itself. So if today there is $236 billion, that was the number when the index inclusion happened, will that number be $180 billion by the time the index inclusion actually happens? And therefore, the quantum of dollars that you can expect may not be that big. But I think the fact that those dollars are about to come in and they are benchmarked, so I think some amount will come in, is actually one reason why I think India should be quite stable. I don't see the elections by themselves, I mean, really being that important. If you think about the direction of travel for the economy, the reason why the economic momentum is so strong is that after a 10-year downturn, the real estate cycle is starting to turn up. I don't think that will change because of any election result. And similarly, the $35 billion of flows into equities are also to a large extent behavioral and systematic. I mean, there's not too much of volition going into those flows. I don't think they are going to change as well. So this whole narrative that we should be, people will talk about it. If you meet investors, every meeting I had over 3 weeks across 3 continents, this issue came up, and I think we are perhaps overestimating the impact of that on flows and liquidity.
Nilkant, the other thing is, and I don't know, I want to get your views here. The outsized bet that's worked so far this year is bet on urban India, the premiumization trend. That K-shaped recovery has played out only for, the Uber reach, and it's not really played out for the rural economy per se. Even right now, the trends and the data points that you're seeing don't really point to a meaningful recovery in the rural end of the economy. Is that a worrisome sign?
Yes, it is indeed worrisome. And it's particularly more worrisome because we don't understand why exactly that's happening. Because if you see strong cement volume growth, every indicator of construction activity has gone up, and you can't really, I mean, however much you may automate, you can't really build houses, build roads without employing a lot of construction labor. And if you remember the narrative at a time when construction activity did used to be strong, which is before 2012-13, it was considered the biggest employer after agriculture. So if construction activity is so strong, it is very surprising to me, and that the data points at for say staples companies, the volume growth has been so anemic. And I can think of 3 or 4 reasons for this. All of them are contributors. It's very hard to conclude on how long they're going to last. The first is that perhaps we are looking at the wrong metrics. Because remember that in the bottom 50% of the population, which is what we are tracking through such metrics, brands are a luxury. And what happened during the pandemic is that the companies that used to supply, if you think about, say, rubber slippers, I mean, some people think that a 200 rupee rubber slipper from a particular listed company is cheap enough. Well, that may be cheap enough for you and me. But if you go to a local hut in a village, you can get a rubber slipper for 40 rupees. So the informal sector or the smaller manufacturers have come back. You must have seen the tax data analysis that 40,000 manufacturers in FY22 didn't file returns. And I think many of those are coming back, and especially as I think some of the listed companies have been a bit slow in cutting prices. So that I think is a very important driver of the fact that perhaps we are looking at the wrong metric, but that may not explain everything. I think the second factor is that inflation sensitivity is very high the moment you go into the bottom half of the pyramid. So some of the trackers that are Access Capital colleagues who cover consumer track show that FMCG baskets are 30% more expensive than they were 3 years back. And if you have that level of inflation, then obviously I think volumes will start getting affected, and which perhaps is also a reason why some of the smaller manufacturers are, I think, making inroads. We have also seen, surprisingly, a spurt in Narega demand, and that's something which is completely confusing, especially as it seems to be very strong in states where there is actually very strong demand for power, very strong demand for cement, very strong demand for cars and everything else. And it could be due to, some delays in processing of claims of Narega or whatever. But you're right, this is a problem that needs to be addressed as to if the rest of the economy is doing so well, why is it that staples companies are still struggling with volume growth? It could be an issue of timing as well, right? Just like a two-wheeler company today announced, and it's made front lines in your the paper from your house as well, that the rural recovery has been very visible, and two-wheeler registrations were up very strongly during the holidays and during the festive season. So, so it is possible that some of this could actually be backward-looking as well.
Now, last question, and again, something where the consensus view is that everything is going right for the banking sector per se. Credit growth is decent, NPAs are low, corporate balance sheets are not levered, so अच्छे नहीं बहुत अच्छे दिन आने वाले हैं. But RBI has come out and has raised concerns about unsecured loan, which is the high growth area for them. So what happens because of that? Do you think assumptions they need to be revisited?
I thought you were also going to say that everything is looking well except the stock prices, right? So so the issue I think with unsecured loans is that so there are two segments in that group. So the total outstanding as of end of FY23 was about 10 trillion rupees, right? So it is not a very substantial part of the overall. It is growing very rapidly, and therefore perhaps RBI is right in sounding out caution and then increasing risk weights and telling the banks to be extremely careful. This is a new market. This is a market that is still developing, and therefore I think it's very important for the banks and the NBFCs themselves to be very cautious. But as I said, there are two parts to it. There are banks that are issuing unsecured loans, which are much larger in ticket size, and there are NBFCs and fintechs, which are also issuing these loans, but they are generally smaller in ticket size and larger in number. The signs of NPAs and stress have now started emerging in the fintech and the NBFCs, but as a percentage of overall loan book, they are a very small number. So if you are, say, 6% of the overall book, and even if you have 5 or 6% of distress or stress, then you're talking about a 0.4% of distress, which itself is not, I think, worrying enough. And for all the data points that we've gathered, it does not look like the bank's loan books on this front are seeing any distress. So most of the new to credit customers, customers which don't have any credit score, credit history. So in a way, the way the system is evolving is that you have a very strong core of existing customers, and or where there is some credit history, where the ticket sizes are big and there is a much more better record of cash flows. And at the fringes, the NBFCs and the fintechs are expanding this market, trying to get into areas which were earlier supplied by informal credit. And there, perhaps some of the algos are not working and they need to recalibrate. So I don't see this as a systemic issue. This, you're right, is one of the major reasons why the financial stocks are looking like they are late cycle, whereas on every other metric, as you mentioned, they are early cycle. So this remains a big overweight for us.
Question more like a tactical question. I'm sure you must have been asked this question directly or indirectly when you were in UK and Singapore, that should one chance their arm to increase allocation ahead of the election cycle, because that could be a 15-20% volatility event, or it is better to come 10-15% higher with a 5-year view once the election cycle is decisively over? When this question has been put in your front, how are you answering that question?
So if there is volatility around election results, either way, I think it's going to be very short-lived, right? Because the economic momentum is very strong. In the 2-3 year horizon, I think the central government's role is not that meaningful. It matters significantly for macroeconomic stability. It matters significantly for geopolitical strategy, for some very large sector reforms. But that matters over 5-7 years. If you're thinking about 2 to 3 years, what matters is state governments. What matters is the inertia that is brought along because of the bureaucracy, which there is a certain way in which the permanent part of the government works, and that is very hard to change very quickly. So when you think about some of these things, the revival in the real estate cycle, the fact that there's a lot of unintended flows that are going into equities, it's very hard for me to envisage a scenario where you see a very volatility that lasts, right? So you could see 1 or 2 days of volatility, but as investors who are trying to invest in India for its medium-term growth potential, my advice would be not to try to time the market around elections.
All right, that's the advice coming in, and good to have you on board to get in your perspective across the board for the overall market trend. Well, just let's mark the markets because it certainly merits attention, sitting pretty at that 20K mark for the Nifty and for the Sensex rather, we've powered through by 375 points. We'll take a short break, be right back with more corporate news.
Back with the market, right on ET now, holding on to that 20K mark. More importantly, it's not just what the index is doing on one hand, what the broader markets are doing. Look at the lively traction that you're seeing across the primary markets. You're already seeing the pre-open indicative price for something like in our radar, 56% premium.
So, Aisha, there are 2 or 3 things which are at play here. When the company went public, post that there is an indication which has come that it will become a PSU Navratna. The minute you become a PSU Navratna, your cost of borrowing goes down. If your cost of borrowing comes down, if you're in the business of financing, I guess, a lot changes for you because the balance sheet sizes are large. Then this is in a business where you would say that for next 3 years, 5 years, 10 years, this is one business which will grow because you are in the business of financing alternate energy. That's where the energy transition is happening, given the capex and how everybody is transiting. So right space and a fillip which could come in from this, whole Navratna status getting approved. And then you got this mad rush of PSU in PSUs right now. Put a prefix PSU, put a suffix PSU, those stocks are getting re-rated. And after a real long gap, something is coming from the government stable, so to speak. So there are a lot of factors which are at play. And there you go, Mr. Pandey, the disinvestment secretary, or the Deepam secretary. I mean, he's a very happy man. And the reason why he's a happy man is because Deepam's mandate now is to create value, not to divest. On the divestment front, they have not achieved anything. But on the other front, surely, in terms of creating value and, managing the OFSS very well and creating value for, by increasing and by improving, communication from, for government companies, I guess he's really managed to achieve a lot. There you go, the listing, eyes down, 2 minutes to go. And you can see the Deepam secretary, you can see the top team of, IDA, they both are there. We'll cut across to them in a second. I think there are still 2 minutes left. 1 minute, I'll stay with it. Let's stay with it. Let's see where the listing happens. 50 rupees, half century, kya baat hai. It's a good debut, half century ka mark.
And also, I think, it's one of those upcoming hottest sectors, right, which the street just so wants the pie off, and very few listed players amongst there. It is actually the largest pure play renewable energy financer. So, how is it that you get exposure to that sector? Could be a via financer as well. We've seen many themes play out in the market wherein the ancillaries have done much better than the pure play companies.
Yeah, REC PFC, where they were versus where they are right now.
Exactly.
This is for 3, 4, 5 years, you can say cycle acha hai. The cycle is looking good. It's only when things take very sudden U-turn in them. For example, if you're financed to a solar company, the prices have come down from 15 rupees to 4 rupees. The unit economics, they change. So when these disruptions, they take place, that's the time you realize, what's happening. All right, let's say hello to a new kid on the block. It's not going to be kid on the block. It's going to be like almost a semi-large cap stock. 51.85. It's much better than what the issue price was. And new listing from the government stable, good exciting day and a good time actually to go public in terms of the market positioning. So yep, it's a good listing and it's a powerful one in terms of where the discovery price is and where the real price of the stock is. Aisha?
Yeah, issue price at about 32, and I think that everyone on the street was talking about how this premium would be justified. As we said, it's a leading PSU player within the space. There's that possible upgradation from a mini Ratna to a Navratna company in the near future. So that will only increase the autonomy. It will allow it to accelerate faster within competition. So a happy day, of course, for the people behind it, and that is Iradia listing at a very healthy 60 to 70% premium.
Yeah, it's not stopping, 72% higher and still counting up. But let me welcome on board Abhijit Roy, MD and CEO at Berger Paints as well, to talk about how their business has been, especially in the light of what's been happening with crude prices. Abhijit, good to have you on ET now once again. And, let's talk about crude first, because those prices have definitely been trending lower. It's down around, 15% from the September levels. How does that impact your business?
So yes, obviously there is a linkage with crude, though it's not very high, but it's still significant enough, and that will result in improvement in profitability. The bases are also on the higher side last year, so overall growth rate in profitability will be quite substantial in this quarter.
When you say that the impact is going to be difficult to gauge, what would be that threshold for you in terms of a global crude prices where you would be in a position to start bringing the prices down?
So Nikunj, these prices have been fluctuating as you have been seeing, off and on. Sometimes it goes down to the 75, 80 level, then it bounces back again to 85, 90. And then there is a great talk that it is going to further increase. So it's not stable, unless it becomes, some sort of a stability is there in the prices. We have dropped the price, a little bit, about 1%. We have, cut the prices this quarter. But depends on how the raw material prices move along with the crude, because as I had always mentioned, there are few products which are directly linked to crude, and then there are many which aren't, like rutile is not linked directly to crude, or for that matter there are a lot of pigments which have got nothing to do with crude, or for that extenders which have nothing to do with crude. So all of these products are on its own. Thankfully, even the titanium dioxide prices have been stable at a lower level for quite some time now. So therefore, the margins are likely to be good for all companies. Definitely for us, and there will be therefore an increase in the profitability this quarter.
Abhijit, not 6 months from now, actually quarter from now, Grasim will make its entry. How will the dynamics change? I mean, are we looking at a war? Are we looking at innovation? Are we looking at new dealer margins? Where do you think things will change?
Because this is a difficult call, unless they come in, and it's only a guesswork as of now. Lots of strategy A, B, C, D, happening. But we know more or less, there aren't too many areas of opportunity to surprise anyone. So it will be a mixture of everything. So probably the ad levels will go up a little bit. Some amount of skirmish at the lower end of the spectrum. That is it. I don't think there is enough space in this industry, I think, for another player to come in. It's not going to be majorly disruptive as such. This is our feeling. And then this is why we are quite confident that, our growth rates that are there, we should be able to maintain near about that growth rate, going into the future as well.
Right. Abhijit, the other thing that I wanted to figure out, and we were just talking with an economist as well before we began our chat with you. Perhaps you would be better equipped to help us understand as to what's happening within the rural end of the market. Is that really seeing a demand uptick or a recovery?
Yeah, so surprisingly, it's the rural areas which are doing reasonably better. In October onwards, I saw a significant up move there in certain parts of the country. So it's slightly different from different parts of the country. The Diwali belt did very well in October, and November also it's okay. It's still holding on. It's the south, especially Kerala, and the east, which is not doing all that great. The bases are on the higher side in these cases as well. So the growth rate has been moderate here in these markets. So rural market, actually we cannot differentiate so much between the urban and the rural. For us, unlike FMCG, our rural is basically small towns, and they seem to be doing quite well.
Are you surprised and also delighted that this year there was impact of inflation, unseasonal rainfall, Diwali and Dashera, they had different base in terms of month, yet the industry has done rather well. I mean, the assumption at the beginning of the year would be that this would be a tough year for the paint industry. Rural demand is lower, inflation and poor monsoon will eat into the disposable pie, but that fear has not translated into reality. Why is that?
So, it did impact a little bit. The second quarter was, muted, in terms of top line growth. You would have seen for the entire industry almost. The third quarter is relatively much better. Of course, we had a volume growth in the second quarter as well, which was in double digit, and that will continue possibly in the third quarter. In paint, we have seen that the repainting demand continues, and fortunately, even the new build sector, which was slowing down earlier, has also bounced back. So naturally, there is a demand which is there for the volume growth to be there, right through. This year, the volume value gap is reversed. So earlier last year, the volume growth was about 11-12%, but the value growth was coming at 23-24% because of the inflation and the price increases which we had taken. This year, the volume growth still remains at that 11-12% level, but the value growth is lower, because we have been passing on price decreases, in the market. So you have a situation where the volume value gap is on the other side. Which is why sometimes it looks like that there is a slower growth rate happening this year, but volume wise we are more or less on similar ground.
There is no value growth this year, given that raw material prices are coming under pressure. Then what happens to volume growth?
No, so volume growth is being maintained at what it was last year. It is in double digits. The value growth is lower than the volume growth. So suppose it is 11-12% volume growth. In quarter two, it was much lower in terms of value growth. It's around 4-5% for us. But in the third quarter, because the mix will change, it will be superior mix. Probably the volume value gap will be much lower. So even if we do 11-12, probably it will be 9-10% or 8-10% value growth. That's how it is happening. Earlier last year, this same 11-12% volume growth was resulting in a 20-23% value.
Good to get in that clarity. Abhijit, great to have you on the show. Thanks as always for taking the time out.
Thank you.
Okay, let's just, revisit the market before we move forward. Of course, IREDA is your star performer today. What a solid debut it's been. And of course, the Nifty as well, chugging along nicely. Well above that 20,000 mark, a level we haven't had since September 20th. So it's been quite a waiting, 70% higher now for IREDA. Let's move on. Of course, we're going to be chatting with Pradeep Kumar Das, the CMD, as well at 10:30. But right now, let me welcome on board. We have with us Arun Ramchandani, the Executive VP and Head Defense at L&T, joining in on the show right now. Arun, great to have you today on ET Now. It's really been all about defense, right? All throughout the year, be it in the markets or outside. But tell me, L&T's defense journey started in the mid-80s, way before the defense sector opened up to the private sector. You're also one of the leaders in the Industry 4.0 adoption as well. Tell me, what's been the journey like? What have been some of the milestones? And where do you think is the potential now for the sector, say, in the next 2 to 5 years?
Good morning. And, very right. The sector has evolved over the years from where we started to where we are today. Post 2001, the sector really opened up for the private industry. And today, the domestic production is, moving north of 1 lakh crores. That's purely domestic production from the defense industry here. And private participation has grown significantly. So from our perspective, we've seen a big play in shipbuilding, in the naval segment, in the land segment as well. And of course, we are looking at aerospace as another potential growth engine for us.
Let me be upfront and address a concern which markets currently are grappling with, which is that
Sure.
what could be the importance of a central election cycle when it comes to defense orders. The fear in the market is that, okay, right now the order book is looking good, but in case there is a change of government policy, change of government, the policies could change, there could be a huge risk. What's been your past experience?
So I think the wheels of change which have been put in motion probably are irreversible. So we don't anticipate any change in government policy per se. The focus on domestic defense production has been very strong. A lot of enablers in terms of policy initiatives, in terms of various initiatives to bring in the smaller scale industry, to bring in startups. All of that have been put in place, and in our view, these are irreversible steps. So I don't really see any kind of rollback on the policy front. The thrust on self-reliance is something that today the world recognizes, and India has embarked on that path. And to me, it's a path of no return. We will move forward on this, and really, government shifts don't really bother us to any kind of significant effect.
Right now we're looking at, and just over the weekend, there were those 3 projects for manufacturing aircraft carriers as well, which, got the go-ahead, right? The 3 mega defense projects, 1.4 lakh crore rupees is the sum which is being touted. Tell me, what share of this growing pie can L&T Defense hope to garner, say, in the next 2 to 3 years? I mean, how much more can your order book grow from what it's currently at? Are we looking at a 2x, 3x, or many-fold sizable increase?
So when we embarked on this financial year, we took a target of growing our order book by about 1.5 times. By the end of the year, we are on track to do that. Let me just say that L&T has created a strong base in the defense and aerospace segment. We have a strong naval segment, like I said, shipbuilding. We have a yard which has, great amount of capacity which we can utilize. There are a number of large shipbuilding programs. We just heard about the announcement of the aircraft carrier program, but we have the next generation destroyers. We have the next generation corvettes coming up. So these are all mega programs. We have the LPs coming up, and L&T does hope to have a share in these programs. So there's good potential on the shipbuilding front. Let me move to the equipment front. We have a lot of capabilities in radars, radar systems, ground weapon systems, naval weapon systems, and as we build platforms, there would be opportunities for all of these to get inducted on the platform. So there would be, potential orders there. On the land front, we are one of the leading players in artillery. We did the K9 Vajra guns. We are anticipating the repeat order by this financial year. And various other artillery programs, the land programs like the future infantry combat vehicles, etc. So there are a host of opportunities there. Of course, the thrust is now shifting to new technology products like unmanned systems, etc. And we are well prepared to provide products in that range as well.
You've also got the overall defense revenues, which is about 2% of the consolidated financials and 3% of the E&C business. What is the outlook on growing the overall contribution of defense, and how do you plan to do so?
So let's just say when we look at the defense segment, we look at growing it multifold from where it is. Of course, when I look at it from a percentage of L&T's growth, with L&T growing at the rate it is, I guess we'll always be playing catch up. But from the perspective of the sector by itself, we are looking at multifold growth. We see the opportunities there in the domestic market. We see that we have a strong R&D base and we can provide products there. We have some good partnerships which we can build on. So overall, I really see an order of magnitude growth in our segment per se. I mean, compared to L&T, we would always be a small segment of L&T, but by itself, the sector will grow and we will grow, I think, faster than the sector grows.
I also wanted to understand what the outlook is as well in terms of, the current state of the light tank Zorawar, the trials for the high altitude mountains. When are those? What is the expectation in terms of the order pipeline? And walk us through the overall order book outlook by the end of the year for defense.
Sure. So the light tank program is progressing very well. We should roll out the tank in December. And I think we are on track to do that at Hazira. This, once the tank is undergo a series of trials, which would then, ultimately lead to ordering of the product in terms of regiments of the product. So I think that's a program which is well started and, on its way to success. Looking at our order book this year, we are doing, the modular bridge systems. We have new orders in the Akash ground systems. We are looking for the K9 Vajra repeat, which are the self-propelled howitzers, and of course the high-power radar program for the Air Force. So all of these are big ticket programs, and we do see they will fructify and lead to greater growth for us in the segment.
The targeted order book by year end, if you could give me the amount.
So we are working towards an order book of about 35,000 crores by the end of the year.
Arun, that the defense orders, the order book looks big, largely because of the cycle, which is that when orders they come, the booking is done upfront, but the execution cycle is minimum 7 to 10 years. Is this time around something is different, or the cycle in terms of how it would evolve would pretty much be same how it has happened in the past?
So I would say that the order execution cycles are shrinking. Both the capacity and capability to produce faster is going up. So typical order execution cycles would be 3 to 5 years as against, 5 to 7 that you have been speaking about. And, that would be the type of cycles. We are having many more short cycle orders. Today, the demand is growing and people are looking at faster delivery. The infrastructure is well set up, the capabilities are there, the technology pieces are in place. And I would say that the order execution cycles would come down moving forward.
Have you on board. Thank you for taking time out and giving us more perspective as to how the defense side of the business for L&T is shaping up. All right, with news that we're at 20,010, we'll slip into a very short break right here on the show. Be right back with lots more.